What's going on, guys? Brian's here. Today is Wednesday, August 16th, 2023, and the market is open. I wanted to do a video that's a little bit different from a lot of the other videos in which I've done, and this one is just going to showcase how you can get pretty creative using different types of butterfly spreads. And I will be covering some advanced topics. If you're completely new to options or you've never traded a butterfly spread before, I'll try to explain a little bit along the way. We'll start off by showing the inception or the idea behind why I decided to enter these two trades. This is the current P&L on the position right now. So as we can see, I'm currently up about $380 to 420 bucks. Again, the market is open. This is where the SPX is currently. It's the combination of two different types of butterfly spreads. So a call spread and a put spread here. They're just using two different expirations, and I wanted to showcase something like this because this isn't something which I've read or learned conventionally. It just came from having the experience in trading after a while and then picking up on things as I go along. So I'm hoping to share and show how you can think outside of the box at times and structure positions in which you're not really taking on much risk and you're not approaching trading very binary. You're creating a scenario in which you have a lot of possible scenarios to actually be profitable. So if we actually take a look at the individual strike prices here, for the beginners, I like to use option strat because it's pretty easy to explain. So what I have is one put butterfly, and it was open on August 11th here at 12:53 p.m. Eastern time. And then I have two of these call butterflies. So I'll adjust it so it matches, right? So there we go. This position costs about $2,000 to open, and this is the expiration right here. This was also opened on August 11th, and then we can see I only have one of these here. So the ratio is for every one of these, I had two of these. Right now I only have two left of these and only one of these, and then I decided, let me record this video before 2 p.m. Eastern time just because there's the FOMC minutes and there's a catalyst on the calendar, so I would like to close out some of these positions, and that's why I figured I'll record this now versus waiting for the markets to close while I still have some of the positions live here and open. Now with one of these and two of these, the first thing I want to call out is pay attention to how much capital I'm using. I'm using about $2,000 here, and then I'm only using $375 here. Both of these positions are debit, so we're not talking about credit spread. So in other words, I paid $2,000 and then I paid $375. Let's take a look at the chart, and you guys can see this is what it looks like here. So this was the 11th, which was last week Friday. It is now a Wednesday right here. This is when I open up the put fly, and this is when I open up the call fly. Now the put fly was targeting 44.25 for Thursday's expiration, which is tomorrow. And then the call fly is targeting for August 24th, which is next week, 4,500. So this is just showing the exact levels on our chart. I originally told myself I wasn't going to talk about why I decided to enter these trades, but I figured that's a little bit of importance too, so I don't want to spend too much time. So just to showcase, a lot of the thought process came from just taking a look at the gamma exposure, as well as also understanding the significance of the 4,500 level for the past couple weeks of trading on the SPX and the SPY equivalent. So if we take a look at this right here, this is just the gamma exposure. This was at August 11th. So again, last week Friday. This is in the middle of the day. Generally, I like to take a look at this when I'm deciding what type of swing trades I want to put on for the next week or the next 2 weeks. We can see that the SPY was at 45.53. If we take a look at the SPX, this is the equivalent here. Let's scroll up to the 11th right here, same time frame. So I noticed that 4,500 was a pretty dominant strike price. However, 4,500 was pretty dominant on the SPX. This is a big OPEX this Friday, which is OPEX just stands for options expiration. It is a monthly expiration, and there's a lot of options that are expiring this Friday during the AM session on the SPX. So Friday morning, and then there's also the usual weekly contracts that expire at the end of the day. And this weekly contracts happens to also be a monthly expiration. So I also like to pay attention to the SPY, especially on weeks like this. So let's scroll back up here, and we have this right here. So 12 p.m. again, last week Friday. What this is showing, by the way, this is just screenshots here from the Quant Trading app Discord. Links to information for Quant Trading app is in the description down below. But moving right along, this right here is just aggregating the gamma profile for the upcoming week. So it's kind of giving me an insight in terms of, we can think of this as I'm looking at the forecast for the upcoming week, and then I noticed for the SPY, this upcoming week here, so from the 14th to the 18th, and again right now it's currently the 16th of August, when I looked at this was August 11th, I noticed that there was a lot of negative gamma. We hadn't been seeing this much negative gamma for a while. And even though the SPY was at 445, I was thinking if 445 did not hold, we were more than likely going to sell off to this area here, which is 4,400. And then this strike price here, which is 442. So on the SPX, that's about, we'll say 44.20. We'll just average it out or so and just kind of give it a range. I'm not really looking to be perfect. I just want this general area so I'm aware of, but at the same time, not ignoring what I noticed on the SPX for the upcoming week. Also, there's a lot of gamma around 4,500. So I wanted to put myself in a position where if we did sell off below 4,500, we see this strike price right here. Below this, there was a lot of potential for the SPX to sell off to this strike price right here. And we can see this little spike, which is 44.25. And then if we did continue to go up, or if the market continued, to recover from this little bit of a pullback that we're having, it would probably stall out around 4,500. So if we look at this, we can see now it is 3 days later and the market ended up breaking. Where's the here's the 44.50 level, and we can see how yesterday there was a decent amount of consolidation on this level as it continued to bounce. It formed a descending triangle here, and then we eventually cracked at the end of the day. Market sold off. Today was the retracement to that level, and then it continued to sell off right down to this target. Now I was originally thinking to use the Wednesday expiration, but I wanted to go with something a little bit safer, so that's why I chose the Thursday expiration, just to give it an extra day, just in case I was off with the timing, because you're not always going to be perfect with this type of stuff, and the idea is to just maintain profitability over the long term. So while we're hitting the strike price here, the implication or the idea in which I would have is that we're going to stall around this strike price. Now again, at 2 p.m. here, so in about 55 minutes or so, there's going to be some sort of a catalyst. So I would like to be cleaning up some of my portfolio. These positions here are I just organized these into a group here just so I can showcase this for this video. I have a few other positions open, but they're not relevant for this video. So as we take a look at this here, if this is your first time looking at a risk profile on TOS or on option strat, I've done a couple videos in the past showcasing how to read this. This is just letting us know this is our profitability zone. This is what's referred to as our break even. So if price passes this strike price here, this position will be in the red. This is the P&L at expiration. So in other words, tomorrow as the market closes, this would be my P&L, and depending on where the strike price is. So if the SPX is at 4,400, I'll make $1,000 on this trade only using $375. If we come to this here and we actually turn off the call strike, with call butterfly, this is the same position here. So we're taking a look at the white is the P&L at expiration, and then you guys can see currently I'm up $490, and that will coincide with, as this is updating here, this is up 460, 495. It's going to be bouncing around because again, the market is live and this is all real-time information. And we can see this is where the butterfly reaches its maximum profitability, which is $2,500. The max amount of loss I can have on this trade, as we can see right here, is what's highlighted in the white. So as I scroll around here, you see the most I can lose would be $365, and the most I can make would be the $2,500. So hopefully that clarifies, how to read or analyze this. The green is what's referred to as the T plus 0 line, and this is the current P&L. So this is the strike price where the SPX is, and this is what's bouncing around. This is the P&L right now. So in other words, if the SPX was to rally all the way up to 4,500, this position, this green, will now be below what's referred to as the 0 line. So as we see this right here, this is our 0 line. If the SPX rallied here, this green will be down here, which would be about negative, right? If we hover, it's letting us know right here. If you pay attention to the green as I move my mouse around, minus $234 if the market was to reach the 4,500 strike. That's the same thing which we're seeing here. If I were to just drag this down to the current expiration, and let's just swipe this here, you guys will see it's about $250. As you guys can see, the numbers are not going to be exactly, because again, things are moving around, and this is real time as I'm recording this, so there's going to be slight variations and differences by about 5 or 10 cents or so in the option. Also, if I'm talking a little bit fast, just because again, I'm paying attention on another monitor as the market is cracking some key levels. I need to make a decision if I need to go adjust some other things, but I'll try to focus as I try to steamroll through this video here. Let's just continue now to swipe back to the expiration. Something I want to highlight, or the creativity behind this, is mixing the expirations. If you guys notice, in the short term, I went with a put butterfly. And because it's in the short term, the way butterflies work is the closer and closer they get to expiration, the closer you are to your strike price, the more profit you're going to make. Because as you guys can see here, this position is up $450. However, if I were to come to this and we go to the current P&L, this position with having 2 grand is only down 120 bucks. So while this is down 120, this one is up 450. And that's what's giving me the overall positive P&L. So if I were to take a look at this, you guys can see I'm up $345. Now, if price continues to sell off here, you guys can see that I'll only be up $34. So I need to make a decision, as this strike price just ended up cracking, or I can continue to hold for tomorrow. But again, I just want to get through this video, and then I'll make my decision as soon as I'm done recording if I need to add some puts to my portfolio or so. But the other key thing I wanted to take away is, let's just say the market was to rally. So let's just say we rallied all the way up to that strike price of 4,500. You guys can see I'll only be down 33 bucks. So that's if we rallied all the way up here. This is telling us at 4,500, what will my P&L be? And you guys can see it's bouncing around minus 30 bucks, up $23 or so. Again, market's open, so these are fluctuating. At the same end, if we look at this here, if the market was to sell off to 44.05, you guys can see I'll pretty much be just barely up. That's right around here. But at the same time, as long as the market is hovering around this region right now, the P&L looks pretty good. On top of that, if we were to jump to tomorrow's expiration now, because that's when the put butterfly actually expires, you guys will notice that the P&L will start increasing the closer and closer it gets to expiration. So tomorrow, if the SPX is around 44.30, let's just say midday, this green line might rise. So let's actually, this green line right here might push up to about maybe here. And that's going to mean I'll be up about $1,000. And then let's just say another hour or two passes by, the green line might rise up to here, and I'll be up $1,500, because this again is our P&L at expiration. So it's something for me to consider if I want to continue to hold into tomorrow. Last week, when I structured this position and I opened it, I did not know for sure which way the market was going to go. Neither did I really care. I was just paying attention to the fact that these are two really important strike prices as I'm analyzing gamma exposure. And if you're using any other type of tool, or if you're just looking at maybe this is previous resistance, and then maybe on your chart you have previous support, maybe down at the 4,400 or so, you can use whatever type of approach you're looking for when trying to, pick out your key strikes or your key levels. Maybe it's strike prices that have a lot of open interest on the options chain, or maybe it's your own discretionary approach. I'm just trying to showcase that you can actually open two different types of butterflies with different expirations and still end up being profitable. Because in this case, let's just say the market did go up. And if we were to come back to this here, and let's jump to tomorrow. So we're still on the 17th. Again, I'm recording this video on the 16th, but we just adjusted this to pay attention to tomorrow. And let's just say the markets did go to 4,500. And the put actually expired worthless. So now the put strike would expire worthless, but the call butterfly will actually be up $256. So that's how it'll cover, or it'll be just about a break even for how much I would have lost on the put spread. Now, if I continue to hold the entire trade, so let's just say Friday, and the market is still around 1,500, you guys can see my P&L starts increasing. Now I'm up 400 if the SPX is hovering around here now, because this is originally where I was thinking we might end up going. If we continue to hold a position like this into next week, you guys will notice again the P&L starts increasing exponentially, because now this call butterfly is getting closer and closer to its expiration, which is the 24th. So we're now looking at the 21st. If I were to jump now to the 22nd, you guys can see it, and so forth. So now this is up 1,400. Let's go to the day before expiration. This is the 23rd. So now this is up $2,000 if the SPX is around here. Even if it ends up pulling back to another significant strike price of 44.70, you guys can still see this will be up $1,500 by next week, Wednesday here. But let's just jump to Friday, and let's actually go to the present day, and then let's turn back on the put side. So I just have these open here. This is the strike prices in which I loosely got filled, and these are the current worth of the strike. So initially when I opened it for around 375, it's currently going for 830. So that's how I'm up 400 and change on the position. And at the same time, this one was originally open for about $10, and now we can see that it's currently going for $9. And again, I have two of these and one of these. And it's just about mixing the ratios and finding a good balance between my P&L curve, and then thinking about where the experience comes into play here, because you end up realizing that you can mix these expirations, you can mix different types of spreads. You're also mixing how much capital is going into each one. It's really about your T+0 line and what's it like going to be and how is this going to be moving during the duration of the trade. In other words, when I initially opened the trade, I was able to analyze if the market pulled back, I wouldn't really be down that much on this. And I knew I would be up a whole lot more on this trade. And this is something that you can do with spreads, not just butterfly spreads, but any spread in general. So if I were to open up, let's just say a long call butterfly, because I think the market is going to bounce, towards the end, by the end of the month. And let's go to the SPX and say, I think we're going back up to 45.50 hypothetically, and I wanted to open up some sort of a balanced butterfly here, and this is what it looks like, the P&L at expiration. However, if I want to see what's it like during the duration of the trade, I will do this and say, okay, for today, if the market went straight up, this position will make $600, $700. However, if the market was to continue selling off, I'm going to lose about $300 to $400 if I wanted to use this as my stop loss. On the other end, let's just say I decided this is definitely going to be a swing trade. How will the P&L be, we'll say, by next week, Monday? Let's come right here. So next week, Monday, which would be 5-6 days from now, we can see if the market just continued to hover around here, I'll only be down $180. But if the market was to rally and then hover around here, this trade will be up about $1,000. So it becomes in my incentive to want to stay in the trade a little bit longer, because let's just say things are working out. There's all sorts of different ways in which you can adjust and get comfortable experimenting with these types of trades. You can paper trade them. I've been trading butterflies for a while now, so I'm pretty comfortable mixing, different types of expirations and spreads. And then you can make them broken wing, you can make them unbalanced, you can do a lot of different types of things with butterfly spreads. But the highlight for this video, and I'll showcase in other videos how to have a little bit more of a creative approach to your trading, is mostly the mixture of the different expirations using different ratios. So 2 of these, 1 of these. The shorter DTE one inherently has a little bit more risk involved, so I'm going to use less capital in this, because let's just say, yes, if I ran with the same amount of capital, so $2,000 in this trade, I would have needed 6 of these, and yes, I'll be up a lot more. But if the market was to rally to 4,500, I'll be down $1,500 in this position. And if the market rallied again with just this $2,000 here to this level here, 4,500, I'll only be up $286. So that means overall I'll be down $1,200 overall, $1,300, and that's what's important. So it's about finding a good balance. So in this case here, opening a trade like this, if I'm in, say for example, you're in 2 of these or 3 of these, that means you need to be in two of these for every 1 of these. So if I'm in 3 of these, we have to increase this to have a nice balanced ratio. And now if the market rallied to 4,500, I'll be up $850 on this. And if the market rallied to 4,500, I'll be down about the same. So it would be break even, which would allow me now to remain in this trade and potentially hold it a little bit longer past expiration, because the implication would be the SPX would be hovering around 4,500. And if new data presented itself and I thought that the market would go a little bit higher, then I can always open up another butterfly spread. Or if I thought then the market would pull back, maybe then I'd open up another type of butterfly spread. The mixing and matching, again, takes a little bit of experience, and it just comes down to getting comfortable with analyzing your risk profile, understanding the key strike prices, and then combining the information together. And then more importantly, having a plan, not only for a plan for risk management, but also a plan for what you're going to do when certain strike prices break, or when your break-even strike prices break. So in other words, by break-even strike price, I'm talking about if we close these all right here, what will I do if the SPX got below this strike price? Because this is letting me know once we crack this level, so we'll just call it 4,400, I'm no longer in the profitability zone at expiration for this butterfly. So I might want to do something, or I might want to add another butterfly here, or maybe just get some puts, or I just need to do something. So that takes a little bit of experience. Hopefully this video wasn't too confusing. I know it's kind of arbitrary or strange to see a video and just mixing and matching different types of spreads like this together. I haven't done any type of research on YouTube or, regarding these types of positioning and these types of plays. It's not something that you read, or at least to my knowledge, you read in a book. Again, you pick it up along the way. So I'm just trying to showcase this, and you guys can get a little bit more experimental with how you're positioning your trades, and you don't have to think of things as so binary. The objective is to create a scenario not only to make money and be profitable, but also create a scenario in which I'm taking on the least amount of risk as possible within means or within what I can control. And we can't control what the market is going to do, but I have some sort of faith that if the market did get to 4,500, it's going to stall around here for a bit, or at least give me half a day or a few hours to decide what I want to do next. The same way as the market comes down to this level, I have some sort of faith that between here, 42 and 44, within this region here, there's going to be a time for me to react and do something, and then I'll decide based on my risk profile and some of the other positions I have open. Also, I forgot to mention, if the price bounces from here and it's just hovering around, say for example 44.50, this is the P&L at that price also. So the reason a person might want to open butterflies like this as opposed to just buying calls or buying puts is because it is long theta, so it's generating profit as time is passing by, as long as price is staying within a certain range. So that's one of the added advantages of running butterfly spreads. I could have also chosen to run some sort of iron condor, but the problem with the iron condor is that as price is getting closer to the strike prices, it won't be generating profits like a butterfly would the closer and closer it gets to expiration. So the closer and closer again we get to tomorrow, this put butterfly is going to generate a lot of profit if I decide to hold a couple $1,000s for only using $300. And then if price hovers around here and then it decides to bounce the day after, as you guys notice, if we do go to 4,500, then the call butterfly will be generating a lot of profits. So it's a situation in which I can generate a lot of profits from both sides using limited capital or limited margin at risk. And then at the same time, if price was just to stall around in the middle for at least a couple of days, I will also generate profit. The only way a combination of positions like this would actually be losing would be if we were to break past these break-even points right here. And that's what these red dashes are showing to us on the chart. So whenever the green dips below the 0 line, that's where I have to worry about. So the 4,500 and then the 4,400 area. So those are the two ranges. Anything in between is profit up until expiration. Thanks for watching, guys. Let me know what you thought in the comments down below, and I'll catch you on the next one.